I haven't got an organised presentation like the wonderful one from Christian, but that's linked to the second apology that I wasn't able to come this morning, and I'm afraid I'll probably have to leave at the break. That's partly because I'm trying to be in many places at the same time this week, but they're all relevant places. I came from New York overnight, Wednesday night, having attended the first day of the ICRIC, Independent Commission for the Reform of International Corporate Taxation, which, as I hope some of you know, was set up by a range of civil society organisations, including trade unions, the Council of Global Unions, and Public Services International, including Oxfam. And the intention of that was really to have a counterweight, if you like, to the formal BEPS process, and particularly to bring together some detailed analysis of what might come out of BEPS and similar reform processes, but bring a more independent and civil society view to bear on that. So we've got a very good range of commissioners in the end, 9 commissioners chaired by Jose Antonio Campo, including Joe Stiglitz, Eva Joly, and so on. And there is a website, so I encourage you all to look at that. They will produce a report, we hope relatively soon, but which will then be presented mainly at the UN Financing for Development Summit in July as part of Oxfam's, and maybe Susanna could tell you more about that, campaigns. So it will provide, we hope, a campaigning focus on these issues about BEPS and beyond. But it's also very important to bring together some detailed tracking, which is why I have been going along to the room down the hall, to the discussions, the public consultations this week. And again, that's linked to Christian's very interesting and important slide about these public consultations, because as his data very clearly shows, and I don't know if that was number of submissions, but if you look at page numbers, they would be even more skewed, because clearly the involvement in the so-called public consultations has been primarily from not even companies, I wouldn't say business or business lobbies, but from tax advisors, from the very people who have the most vested interest in the existing system. So we've been through the BEPS monitoring group. The other intention of, in fact, both the commission that I've talked about and BEPS monitoring group were set up about 15 months ago, again as civil society activities, to have complementary focus functions. The commission to try and, as I say, bring high-level attention to bear and open up a broader public debate, and BEPS monitoring group as a network of tax specialists who would try and track the detailed technical proposals, provide input into those, but also try and explain those as far as possible for a wider audience. So we do have a number of civil society researchers involved in BEPS monitoring group. We are producing reports on all of those, which we hope are comprehensible to everyone. If you can't read the whole report on each point, we try and put in a summary, so at least read those. So we would encourage you really to look at that, because it is very important to track the two. But I'll try and summarize briefly what I think will come out of, or it seems to be coming out. There's still a lot to play for in the next few months, and then try and fit into Christian's very useful broader perspective. Because in many ways, I think the BEPS project is coming out in lots of ways as we kind of predicted. Just to summarize, I don't know how many of you have been following the issue, but broadly speaking, the existing international tax rules, as Christian said, designed nearly 100 years ago, were designed in an era where most international investment was portfolio investment, where you had investors in one country and businesses in another. They apportioned rights to tax between taxing business profits where the business was, and returns, interest, and so on where the investor was located. But they knew already that wasn't appropriate for internationally organized businesses, and then there was a kind of modification of that basic rule to say, well, in the case of multinational businesses, of which there were some, you should treat the different entities in each country as if they were separate and as if they were independent of each other. And that little innocuous Article 9 in the League of Nations Model Treaty still is continuing today, and it was brought up yesterday by a representative of the Silicon Valley Tax Directors Group. and I was very pleased you brought it up, because we also go back to that. And that Article 9 simply says that tax authorities in different countries can adjust the accounts of entities, but it does say as if they were independent. But it's become highly distorted increasingly, particularly in the last 30 years or so, because increasingly the emphasis has been on adjusting them by focusing on transactions between the entities and trying to find comparable market transactions. And it's not only economically illiterate, but also actually has provided the incentive for multinationals to set up entities in these different jurisdictions. So it's not only the opacity, obviously, of tax havens, but the fact they can attribute artificial profits to low tax jurisdictions. And that's become even more difficult because it's not only the classical tax havens, Cayman and so on, but now increasingly that's created a situation where if they can persuade different jurisdictions to establish a favourable tax regime, they can locate there. So it's not only Cayman, but as we know, Luxembourg, Ireland, Netherlands, the Dutch sandwich, double Irish, which people have begun to become more familiar with. What used to be talked about only in the specialist tax journals, now I hope more people are becoming familiar with it. And it was really that, combined obviously with the global financial crisis and the fiscal austerity that has pushed the governments, finally, to set up the BEPS process. And we keep reminding the people down the hall there that the mandate they got from G20 was to reform the rules to ensure that companies, and it clearly means companies treated as unitary entities, which they are taxed where economic activities take place and value is created. That is what they're supposed to produce. Now that has really put them under a lot of pressure because many analysts, particularly academic commentators and so on, have for over the years, decades, argued that that does mean moving away from this artificial separate entity principle and treating multinationals on a unitary basis and put forward an alternative of so-called formulary apportionment. But the BEPS action plan kind of rejected formulary apportionment because they said that would be artificial, governments would never agree on the formula. But that also obscured the intention because the request to tax where economic activities take place clearly does require a new approach to treat entities as unitary. So what we've been pushing from the beginning is, fine, you don't want to move to a fully fledged unitary formulary apportionment system, but nevertheless the mandate you have is that you should look at firms as a whole and tax them according to where economic activities take place. The other important mandate they got was to produce a template for country-by-country reporting, which would then make it very clear. Country-by-country reporting would show where they're declaring profits by country, where they're paying taxes and where their tax liabilities are by country, and where they have employees by country. Now, under that political pressure, they did produce a template, but there's a kind of conspiracy amongst the tax authorities and the companies to say, okay, we've produced a template as we were told, but they will only be produced to the parent parent country, to the home country of the multinational, and shared with other countries subject to conditions of confidentiality and appropriate use. And it specifically says appropriate use means it should not be used for, quotes, formulary apportionment. Now, there's not in country-by-country reporting template, there's nothing you could say is commercially confidential. No. So the only reason they are keeping it confidential is that they don't want a public spotlight on the relationship between declared profit and taxes paid and employees. They don't want any public debate about whether taxes are in fact being paid according to real economic activities. Nevertheless, the detailed changes that they have been discussing are intended to produce that. And they know there will be scrutiny of that. I mean, the reason for this is everyone's become increasingly aware that declaring a lot of profit in places where you have few employees doesn't work. So they're really in a bind now. They're really in a bind. And many of the individual proposals that they're trying to tweak here and there, they are moving towards apportionment principles. but they've probably moved stronger towards apportionment principles in the apportionment of costs, particularly on apportionment of interest costs. That probably was the most strongest report, although now there seems to be some moving back away from that by the US, which apparently was strongest for it. The strong proposal was that interest costs should be taken on a consolidated basis, and the consolidated third-party interest costs should be apportioned probably according to EBITDA, earnings before interest, tax, depreciation. And there was strong support for that. They had a private consultation. They had consultations with business, but also with academics. And we were there for that with half a dozen. And all the academics and researchers were agreed that was the way to go. But they seem to be pulling back away from that. Now, it's easier to apportion costs, particularly for home countries of multinationals, because that's pushing out costs. And the other area where they are also proposing it, which they're discussing this afternoon, is central service costs. But that again pushes out costs from headquarters to operating companies. So one can understand why they don't want to do that a lot. There's a lot of resistance, obviously, from source countries to an apportionment of central service costs. So although we agree with the principle of apportionment, we're saying, well, it shouldn't only be costs. It's more easier to accept. It is easy to accept on interest costs because the extent to which they use internal loans to reduce the tax base is such that using this, they had some data, and it's interesting to look at that report. I don't know if you looked at it, Christian, but they produced data just looking at the 100 biggest, and apparently they haven't used the data which revenue authorities themselves have to do better studies. But it showed that on average, third-party interest costs are only about 10% of EBITDA, but existing interest rate caps, which countries have used, is usually about 30%, which is obviously far too high. So apportionment of costs is okay. The real issue, obviously, though, is how they will move towards profit allocations. In that area, it's mainly transfer pricing rules, and the problem there is they're completely, it's a complete mess. The existing system, so-called arm's length pricing, means you have to look for comparables. And everybody knows that the whole reason for existence of an integrated company is that they're not comparable to independent entities. And finally, that is being said loud and clear. Again, fantastic. Yesterday and this week, I think also on Wednesday, I wasn't at the meeting Wednesday, but the delegate from China said as clearly as anything, she heads a transfer pricing unit, audit team, and she said, we don't find comparables. In 100% of the cases, we don't find comparables. Before, you could only get them to say that in private, or former advisors would tell you this, but now it's being said loud and clear that approach does not work. Now, they did accept 25 years ago a concept of profit split, which moves towards an apportionment approach. But it was accepted only very reluctantly within the OECD as a residual method, and they call it transactional profit split. And they like to say, well, you should only use it after you've done a functional analysis. So what they now seem to be proposing is that you would still require tax authorities to go through this very exhaustive, detailed, time-consuming, case-by-case analysis for every company. And they're still saying you should start from separate entity and the contracts. So, I mean, it's completely fictional. I mean, it's going from there to here. It's like, I mean, I'm going from it's like Alice in Wonderland. You go to them down there, and they seem to think that this is reality world. But I go to the commission in New York with, people who know how the world works. I mean, these are business people, Ocampo, Stiglitz, and so on. They know what the real world is like, but the people down the hall, I don't know if they really believe what they say. They seem to believe the fictions they've created. They seem to believe that the 1,000 subsidiaries that most of these companies have are somehow real entities, and they actually have contracts amongst each other whatever it is, Google, dual resident in Ireland and Bermuda is kind of a real company, and it has a contract with Google, which is really an arm's length contract. I mean, they live in a complete fantasy world, but they nevertheless, and the proposal still seems to be to stay with, you must start from the separate entity, you must look at the contracts, and then you can adjust the contracts according to functions, assets, risks, and only after that do you apply methods, and the methods you apply should be the whole range of methods, comparable, blah, 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 and only at the end of the day apply profit split. Now that clearly is unworkable, and the Chinese delegate is telling them very strongly no. Others are as well. After this morning's session, the Mexican group asked me to go to lunch with them, and they said exactly the same thing. How can we move towards a more functioning system? So what they will come out with is likely to be really still very confused. I'm trying to represent a more realistic point of view, and I think we're making some headway. People keep saying they kind of agree with me, but then the bulk of the tax advisors still say, no, but however, we must start from separate entity. So it's hard to tell what they will come up with. It's likely to be even more messy. It's possible that a group such as the emerging country group like Mexico, China, Brazil might, and I suggested to the Mexicans, maybe that will be one way to move it forward, because people are fairly clear that they won't come out with a very rational, or certainly not total solution. So what can we hope for at the best from the BEPS process? Because of the political pressures, I think at the very least they have to try to come out with a system where, by one means or another, profits are attributed more in line, where you won't get these scandals. And things like your McDonald's report and so on, it's essential that NGOs, trade unions keep doing those, because that's what puts pressure on the companies. If we can have more of those reports, like the SAB Miller report from ActionAid and those reports, that's what puts pressure on them, is reputational pressure. So what might we hope for is a system by hook or by crook that will force them to have a more equitable, if you like, apportionment of profits in relation to real activities. Now, what impact will that have? I think it will result in probably quite a significant reduction of tax avoidance. But I think we shouldn't overemphasize that. We shouldn't raise expectations. I'm not an economist, so I'd be interested in estimations. There is obviously a very serious tax gap, and a significant amount of that comes from international tax avoidance. And hopefully this will plug some of that, so there will be some fairly significant, I think. But I think we shouldn't overestimate that. That's probably not the primary aim. There may be a very significant aim, but I think there are other quite important targets. One is to remove the incentive for international groups to use these devices and to use the offshore financial system and the tax haven system. They invented it, they devised it together with wealthy families in the 1930s and extended it in the 1950s. And it was after they'd pioneered the use of Cayman Islands, Bermuda, and all these devices, that then after financial liberalisation in the 80s, everyone started using it, mafia, money laundering, and so on. So if we at least can remove the incentive for companies to use it, and particularly, I fully agree again with Christian, the financial services industry, because that is the reason they use it more than others is because it's much easier to locate fictional aspects of activities. You can book transactions. Cayman is a supposed headquarters for a large proportion of hedge funds, because they can book the transactions in Cayman Islands, where the actual analysts are all sitting in Frankfurt, London, and New York. And doing that reduces their cost of capital. What contributed, it's very major, and I think your statistics show that. But I've always said that a major reason for asset bubbles that led to the 97-98, but also then obviously the 2008-9 financial crisis, was the very low cost of capital for these large integrated banks, which came partly from the lender of last resort, but also significantly from the tax avoidance opportunities. So that will be a second very important aim, I think, if we can remove the incentive for using the tax haven system from multinationals. The third one, again, relates to Christian's point about staffing in tax departments. Because the dysfunctional nature of the rules, starting from the fictional arm's length really has opened up the floodgates for all these people down the hall, for these hundreds and thousands and even maybe probably hundreds of thousands of tax advisors to make large sums of money, particularly from transfer pricing rules. The last 25 years seen an enormous growth of the Big Four and all the tax avoidance practices. And they're the ones who sell their services first to the companies and then to governments. Even the US IRS, I don't know if you saw recently, had to hire specialist analysts at the cost of $2 million to help them with the audit of Microsoft. So if the US IRS has to do it, what chance do you give Mexico, but let alone Mexico, Tanzania, or other countries? Because of the increasingly highly technical and specialist nature of the processes. And that again links to what is happening down the hall, because they also are in this kind of dilemma, and they know that what is emerging is probably greater attention on the division of profits and probably on the profit split method, and that's what we were discussing this morning, profit split. And it was fascinating. I do recommend you to watch the replay on the OECD website. It may sound boring, but it really was fascinating this morning, because yesterday, in fact, one of the tax advisors ill-advisedly used the analogy of saying, why does the OECD want to do this? They're rewriting the rules in the middle of the game. You were there, were you there? That was fantastic. You know, they're losing the game, so they're rewriting the rules. So that gave me the perfect opportunity to say, what game do you think you're playing at? This isn't the game is that taxpayers around the world are aware that they are paying for the costs of austerity and so on, and you say you're losing the game, you know. But then the chap who's taken over as transfer pricing specialist at OECD picked up the analogy, and he said he comes from rugby, where the game of rugby was invented, where someone, instead of kicking a football, picked it up, and that created a new game. So I reflected on this overnight, and then this morning, what was amazing was that that's what kind of emerged, because they started talking about the profit split method, and you suddenly have these young dynamics. There's a young chap from Taj, a French firm, and another one from economics analysts or something, another one. And they were coming enthusiastically into profit split. And they're saying, yes, we can do profit split, and you need this complicated methodology. You need economic analysis based on cost of capital, blah, blah, blah. And they started devising, really exciting new profit split methods, So then I came in and said, we are in this situation where the OECD has to decide, is it changing the rules of an existing game and therefore making it more complicated? Is it devising a new game, or are two games going to continue to be played on the same field, where you've got the kicking the ball and the picking up the ball? And I think that analogy goes quite a long way. That is the dilemma that they are in. And they're all in that dilemma, because systematizing profit split would move them towards formula apportionment. It might be a much better solution. It would mean it wouldn't have some of the disadvantages which we would acknowledge of a full formula apportionment system, which is having a rigid formula for all industries. They could move in that direction. That's what we're urging them down the hall. They're unlikely to do that. So what the business people who understand the issues, particularly Will Morris from BEAC, is saying, well, let's take it slowly. So he's saying, well, let's only rewrite part of the guidelines, section D1, and we'll leave this other more difficult stuff, not for the indefinite future, but to be done on a slower pace. Well, my response was, well, maybe if you want, because there is a danger that it could be very messy, but only if you're willing to talk seriously about what the alternatives would be. And that might start to move it away, again, in terms of where will we go after this. But if they stick to the timetable, it's I mean, we put forward a possible way they could move forward more strongly on profit split, which would be to have a default allocation key, a default set of allocation keys, which might be a balance between employment and sales, but then try and develop industry-based allocation keys. And there was some very interesting support for that from a guy from the luxury goods industry, an Italian. I don't know if we've got time for him, because I talked to him last night over drinks. And he's a guy who came from tax advisors and went to work for Ferragamo. And he said he started to apply all his techniques he'd learned, and he managed to save them 2% on their tax bill. And he went to the finance director. He thought he'd be rewarded. And the guy said, you know, we just put up our prices up by 5 or 10%, and our customers still are willing to pay that price. And, you know, we got the cash flow. We don't need the tax avoidance. So, and what he put forward was a framework where you could develop industry-based allocation formulae, which would provide industry with security and stability for the longer term. Now, there may be some support for that in business. What I was appealing for here is that what you need is for tax authorities and businesses themselves to try and get more accommodation and cut out all these middlemen, all these, you know, because really that will be, and in terms of the resources of tax authorities, that might be a way to go. I mean, obviously there will be continuing pressures that we should fight for more staff in revenue authorities, but you can never keep up with the possibilities that businesses have for paying the Big Four and so on. And so simpler methods that are easier for tax authorities to apply, and maybe we would start to get some support from some business sectors. I think that might be the way to go. And if those simpler methods, coupled with the greater transparency that I think inevitably we will get, country by country, they might try and slow down accessibility of the reports, but sooner or later they will start being published. If we keep pressing, they will be published. So what we might hope for the best, it won't happen this year with the whole BEPS process. That's why we should think of it in terms of a longer campaign. But we might get some very significant changes out of BEPS that should look beyond that to new forums, including the Commission that we've set up, including other forums where we can fight. And I think there might even be some alliances with some sectors. There are very uneven benefits to different industry sectors, to businesses based in the US-based businesses, I think, have been the biggest probably developers of tax avoidance for a number of reasons, partly because that's the US way, but also because of the big imbalance between the US marginal corporate tax rate, which if you combine the federal and state taxes is 40%, whereas, you know, obviously in other countries, and in the UK now it's down to 20. So there are a number of reasons why there are imbalances there, but if we can divide the business sector, split them off from the tax advisors, I think there are a number of tactics and strategies we can develop in the next few years, but we must keep up the campaign.
Thanks. So, thanks for taking time.